This is Dr. Vara Lakshmi, and I'm going to be discussing you the fifth module of the business economics and the financial analysis. It's about the financial accounting objectives, functions, and its importance. Once a particular demand is identified for the product, the next step is to produce the product. That first P starts with the production, and the last P will be ends with this promotion. And this meanwhile of the production function, cost, if they are going to be producing any product, they'll see the cost, how much of amount they are all spending for the producing of this product. That has been done in the form of cost analysis. Once the cost is identified for the product, the next step is to fix a price. That is second P of the production, second P of the product mix. The next one is, once the price is fixed, then they'll see about the placing of that particular product in the markets. Then they'll see how to establish an organization to sell this product and manufacture these organizations. And we have discussed in this fourth module the financial matters of that particular production. Now, in the fifth module, it is like the Chitragupta. He is going to be recording the each and every rupee which is spending for the organization. That is how the rupees are all comes into the organization and how the rupee is goes out from the organization. That is going to be analyzing or evaluating with the help of this accountancy. So in this, let us have the discussion about this financial accountancy. What are the objectives, functions, its importance in this business economy aspects. We'll have the discussion about them. First of all, the meaning of the accountancy. Accountancy means it's a process of identifying, measuring, communicating the economy informations to permit informational based judgments or the decisions by the users of the organization. Let us say, so first of all, what kind of the information means? They are going to be identifying the information about the funds. First, we have to be ensured the meaning of the funds. Generally, if I ask you what's the meaning of the fund means, most of you will give you the answer that money or the monetary items which are money or the monetary items which are is there in your mind that you will kept. But that is not at all a correct answer, because money means the currency notes which are approved by the regulatory authorities and the Central Bank of the India, and the monetary items means the valuable things which which we can convert into the currency like gold, precious metals, etc. But unless and until this money or the monetary item is used by us, then it will not be called as the funds, which means that money or the monetary item should satisfy the needs, wants, desires of the people. Then only we can call that particular amount as the fund. Let us say, if you have went to the hotel, you thought that you have your purse with you and you have eat all the food, you have ordered the food and you have ate that one. But after that one, you realize that the purse is not there with you. Then but unfortunately, you are not recognizing that with your in your back pocket, there is a 2000 rupees note is there. So if you don't know that 2000 rupees amount is there with you, then it will be called as just a money only. It won't be called as the fund. At that time, the chain or the gold ornaments which are having by you, if you have kept as a collateral, then that previously it was only the gold chain or the gold ring only. But if whenever you are using for your needs, wants, desires, then only it will become the fund. Or else your friend has came and your friend is giving you the amount, or he has paid that bill. Then at that time, that money which he is spending for your needs, wants and desires is called as the fund. So fund means any money or the monetary items which are going to be satisfying the needs, wants, desires of the people, then only it will be called as the fund. Okay, so these funds are required for every organization. So those are funds which are using for the smooth functioning of the business entities is called as the capital. So the funds which are using for the smooth functioning of the business activities is called as the capital. Now, which means literally the capital means every rupee spending for the organization. If it is a business organization, then for that organizations, they require the money. That is, they require the capital. Rupee will be comes into the organization. And they won't generate the money here. They will be produces the goods and they will spend again this rupee for their activities, for their requirements. Like households also will get their income and they will also spend this amount for their activities. Same as the business entities are also going to be spend this amount for their activities and they'll also acquire this funds. Owner will invest the capital and also that amount, that same capital only using by this owner or the organization for their activities. This recording, that means first of all they will identify how much of amount is comes into the organization and how much of amount is going out from the organization. So that is first step of this accountancy. So as an accountant, this capital is going to be first of all identifying. So how much of capital is required? Suppose if this organization, how much of infrastructure is required? And how much of machineries are all required, how much of human resources are all required, how many buildings are all required. For all this one, they are all going to be identify this expenditure or the capital requirements. Then, once if it is identified, they need to be measured. So, is that rupee, in what way it is coming? And is it in the form of the things or is it in the form of the monetary items? In what way it is coming? And they are going to be summarizing. So finally, how much of money is got, how much of cash is got, how much of another things were received, and all these things, and in what way they are all going to be spending. Like for the fixed items, how much of amount they are all spending. For the current items, that is day-to-day activities, how much of amount they are all spending. And for the fixed items means for the land and buildings, how much of amount they are all spending, and how much portion of the amount they are going to be spending for the machineries, plant and machineries, and how much of amount they are going to be spending for the infrastructure or the logistics and supply chain, and how much of amount they are all spending for this raw material purchases, and how much of amount they are spending for the wages and the salaries, and how much of amount they are paying for the rent, etc. So all these things are all summarizing. First they will identify the requirement of the funds, and then they have measured that funds. Now they have summarized and interpreting that. So this is the cash reserves, this is the expenditures. So like this, they are all summarizing it and communicating that particular information to the users. So all this information is about the funds only. So in what way these funds are all coming and where they are all spending, for which activities they are all spending, how much of amount is left there with them, or how much of debts are there for the organization. So like this, all these informations they are all identifying, measuring, summarizing, interpreting, and finally they are going to be communicating in a beautification manner, in a pre-described manner. So that is called as an accountancy. Okay, here I have told you they are going to be communicating to the users for the taking of the better decisions. Now, I'll tell you who are the users. Users means the persons who are getting this information and taking the decisions. Let us say the investors or the bankers. And an organization, ABC company, has went to the bank and it has asked for the loan. Then the bank has to see what is the capital of this organization, how much of assets are all there with them, how much of liabilities are all there with them, how much of debts it has. All this information it has to know, then only it can provide the loan, whatever that is asked by the banks or asked by the organization. Otherwise, they can't give that amount. Even the investors are also, they can't purchase the shares unless and until knowing the growth of that particular organization or that particular organizational assets and the liabilities. And the government is the government wants to implement the taxation policies of that one. Then based on these books of records are only. Otherwise, every organization will say that we didn't get the profits, we got this much of profits are only, like this they'll say. But the government, it is mandatory that all the organizations has to prepare the books of records, books of the accounting records, and they should be certified by a authorized auditor. Unless and until that is certified by this auditor, the government is not accepting them for the tax payments. So all these are all called as users: the government, auditors, researchers, investors, owners, employees, customers, suppliers, etc. All these are all the users. They have to know this organization's health position, wealthy positions, that organization's profitable positions, organizational activities, in what way it is going to be earning. All these things they are all should know. Based on that one only they can take the decisions. So for that decisions, that information is going to be provided by the accountant by identifying, measuring, summarizing, interpreting and communicating that information to the users in a pre-described manner with some analytical techniques. So anyhow, this is all about the definition of the accountancy. This is a definition provided by the American Accounting Association. Okay. So the next step is that accounting definition we have seen. The accounting cycle. Accounting cycle will be starts with journal entries and ends with balance sheet. So generally, this accounting cycle or these steps were prescribed by American Association of the Accountancy. This American Accountancy Association has provided some prescribed steps. Every organization must follow this bookkeeping method. First, accountancy process will be starts with journal entries. Then it will be this jarn means day, all means activities. So the day-to-day activities of the organization, daily they will note it down under the journal entries. Then the second step is, once if they have noted down, they are going to be segregating in the form of the ledger. And the third step is trial balance. Finally, how much of amount is going to be debiting and how much of amount is going to be crediting, they are going to be analyzing with the help of trial balance. If at all any modifications are all there, they will adjust over there. Then after this adjusting entries and the adjusting trial balance, they'll go for the trading account. And trading account, after this is the collection of the direct accounts information, and later they will prepare this profit and loss account where the indirect accounting informations will be taken care, and finally they will prepare the balance sheet of the accountancy. So these are all the 6 steps of the accountancy, that is from journal, ledger, trial balance, trading account, profit and loss account and balance sheet. So these steps are going to be using by the internal users as well as the external users. They are all the lenders, that is those who are going to be give the loans to the organization, those who are going to be give the raw material. You may have the doubt that why the suppliers requires this information means the supplier if that supplier is providing the credit sales, or if the supplier wants to know whether this particular purchaser will be continuous furtherly or not, he has to estimate that one. That can be known with the help of this accounting information only. Customers, suppose if that company is in losses, if we purchase that product, next time we may not get the same service from that particular organization. And the taxation authorities, competitors are also should know how much of amount they are spending and how we are all spending under all. The government has to give the subsidies, or the government has to concentrate on the promotion of that particular organization. Since they should know the accounting information. Normal public, they should know which industries are going to be developing in this particular country, and where can they expect the more number of the jobs and all. And apart from this one, even the researchers and even the any other investors, shareholders, regulatory authorities, all these people also should know this accounting information. Internally means the owners of the organization, the shareholders of the organization, managers, employees, everyone should know about that particular organizational information. So, before going to have the knowledge or the discussion on this accounting, let us have the discussion about the basic terminology of the accountancy. First of all, debit. So, debit means subtraction of the funds. For example, in your particular account, nowadays everyone has a bank account. In your account, if you have withdrawn the amount, then obviously that amount will be records under debit. So here is it also. If it is an X company, if the funds comes into the organization, then we can say that the funds were credited. If that funds were spent by the organization, we can say that funds were debited from the organization. In a short form, debit can be denoted with DR, whereas the credit can be denoted with CR, that is adding of funds. First of all, here these two terminology are the verbal forms. So this is an activity. The activity of adding the funds is called as the credit. The activity of subtracting the funds is called as the debit. Let us say A has given some money to the B. So now the funds are debiting from A and are crediting to B. At the time of repayment, B has repaid to A, means again from B the funds are all debiting, whereas those funds are all crediting to A, because credit and the debit are the two verbs or the activities that denotes the adding of the funds as well as the subtraction of the funds. And if we have converted these verbs into the nouns, credit will become the creditor. So creditor means the person who gives the money. The person who gives the money. And here the A is called as the creditor. And the person who receives the money is called as the debtor. Here they are all the nouns. That's why I have told you the persons. The persons who received those funds. So who received those funds is called as debtor. Here, these cannot be interchangeable. A is a creditor and B is the debtor only for this particular activity of fund transferring. So A is a creditor where his funds were initially debited and credited to B, and B is the debtor who received those funds, and after certain time period with interest or with a commission rate, with a discount rate or any other value added things, B is debtor only. He has borrowed those funds and now he is repaying to this lender of A. So creditor can be called as the lender, and debtor can also be called as the borrower. Lender and borrower. So we came to know what's the meaning of the credit, debit, creditor and debtor. Next thing is fixed assets as well as the current assets of the organization. So fixed assets means the assets which are going to be running for the long term activities. Generally, in accounting terminology, more than 1 year will be called as the fixed. Below 1 year will be called as the current. Generally, medium is also there. Medium is also a part of fixed elements. So if we have seen any house, land, building, furniture, infrastructure, etc., we can say that we are going to be investing one-time investments only. So that means these are all going to be using for the long-run activities. So that are all the assets, or first of all, the meaning of the assets means anything which is going to be creating benefits to the organization is called as the assets. In that one, if that benefit is going to be enjoying by the organization for more than 1 year, then those assets will be called as the fixed assets. For example, land, building, machineries, infrastructures, etc., etc. And the assets means already I have told you that anything that creates beneficiary to the organization, and if that assets are all within 1 year span, then that assets will be called as the current assets. For example, the cash as well as the stationery, raw materials, etc. will be called as the current assets. And the liabilities, again the liabilities are all the current liabilities as well as the fixed liabilities. Here, the liability means the responsibility of the organization which they have to be meet is called as the liability. For example, land is purchased. Land is the fixed assets, but the bills payable is the responsibility of the organization. Then that bill is called as the liability. Loan is taken. The amount which is coming for the organization is called as the fixed assets or the current assets or the receivables account, revenue or income for the organization, But if they have to repay that bills, then that is called as the liabilities. That loans, interest amount, EMIs, everything they are paying is called as the liabilities. These liabilities which they can meet after 1 year is also that is long-term loans are all there, then that is called as the fixed liabilities. The any expenditures like bills, rents, power bills, etc., if they have to pay within the 1 year is called as the short-term liabilities. And if all these books of the records are done perfectly or not, if they verifies, if they analyzes, then it is called is that process of verifying or analyzing every transaction to the consideration is called as the audit. And once if the sales or the purchases were done, they can done in two ways. Either they can done the cash sales or they can go for the credit sales. Either they can go for the cash purchases or they can go for the credit purchases. If they have done the credit sales, the bills they have not received the cash, they have raised the bills. They are all called as the account receivables or the bills receivables, because the money is not yet received by the organization. They have to be get in future, then that is called as the account receivables. Then the money which they have to receive in which they have to pay later is called as the account payables. This can be done when the credit purchases were done by the organization. And the next thing is equity as well as the debt of the organization. Equity means the owners amount or the ownership equivalent amount invested in the organization is called as the equity. So for this one, we have to better understand about this terminology, what is the meaning of the shares and all. So if an organization is there, then that organization's capital can be divided into equal parts. Then subunit of that equally divided capital is called as the shares. These shares can be invested in the form of the equity shares, or is in the form of the preference shares, or is in the form of the debentures that we have already discussed in this module 4. So the equity and the preference shareholders are all expecting the dividend of the organization, and they are all like the owners. Even the owner is also invest in the form of the either equity or the preference ownership capital, etc. So they are all ready to take the highest risk of the organization. Then that capital will be called as the equity capital, and the amount which is invested by them in the form of the shares or in the form of the any part of the loans they are provided, they are expecting only the interest rates. Even if the organization get the loss or profit, they are expecting their returns. Then that will be called as that capital will be called as the debt. Equity and debt capitals. Equity capital as well as the debt capital. The remaining are all will come to know in this next procedures and are all. And finally, this is equation of the accountancy. Very, very important to understand about this one. The organization's assets should be equals to the liabilities plus shareholders' equity. For example, a owner is there, and a owner has invested his own amount, and that owner has invested the land, and he has invested his computers, and he has invested his cash, and he has taken certain loans, and he has taken some credit purchases. Then in this one, land, computers and cash are belongs to this owners, means shareholders, and he has taken the loans, credit purchases, etc. means his liabilities, his amount plus his taken amount, and he has invested in the organization. That should be in the form of either in the form of the buildings, or is in the form of the furniture, or is in the form of the cash. It should be there with the organization. So, or is in the form of the raw materials, whatever it is there. Then that entire amount, the owner's amount as well as his taken amount, his liability amount should be equals to these assets which are there with the organization. So that is about the accounting equation. Always assets is equals to the liabilities plus shareholders amount. Then assets and its types, we'll have the discussion. So anyhow, assets means we come to know that one, anything which creates beneficiary to the organization is called as the assets. These assets are all categorized as fixed assets, current assets and fictitious assets. The assets which are purchased for long-term usage, minimum 1 year, and are not likely to be converted quickly into cash are called as the fixed assets. The assets which are purchased or expected to convert into cash within an year, maximum not more than 1 year, are called as the current assets. Next thing is fictitious assets. Fictitious assets means these are all, however, they are shown as the assets in the financial statements only for the time being, and the purpose of creating a fictitious assets is to accounting for expenditures, but they are really not occurs. They are not at all beneficiary for the organization. Now, these fixed assets are all categorized as tangible and intangible. Tangible means which we can touch. Intangible means which we cannot touch. We can feel them. Those tangible assets are all like buildings, land, machineries, computers, land, vehicles, etc. Whereas the intangible assets are all goodwill, trademarks, copyrights, patent rights, long-term investments, long-term advancements. All these are all called as the intangible fixed assets. So, like these are all related to this IPRs, intellectual property rights. Then, tangible current assets are all the inventories, cash in hand, cash at bank, stock, raw materials which they have purchased, etc., will be called as tangible current assets. Intangible current assets means the debtors, bills receivables, prepaid expenses. These are all called as the intangible current assets. And the fictitious assets means preliminary expenses. Already they have paid they have to pay previous expenditures, now they are all paying. And promotional expenses, they are all spending for the promotionals and advertisements, and discounts allowed on issue of shares and the debentures. These are all called as the fictitious assets. And the liabilities, something valuable that a business owes have to pay in future, or the organization's responsibility to pay is called as the liabilities. These liabilities are all categorized into three: fixed liabilities, current liabilities, and contingent liabilities. A fixed liability is a type of the debt then that can be repayable after 1 year or more than 1 year is called as the fixed liabilities. For example, debentures, mortgage loans, long-term loans from the banks, from the financial institutions, and from the partners, etc., will be called as the fixed liabilities. And the current liabilities means creditors and other outstanding expenses that are expected to pay within a year is called as the current liabilities. For example, any short-term loans, credit cards, loans, overdue facilities they have utilized, outstanding expenses, bills payable, etc. is called under the current liabilities. Contingent liabilities means financial case pendings, guarantee undertaken. These are all not referred to them, but due to the situations they were occurred, then that will be called as contingent liabilities. Then the next concept is accounting types. This accounting, if the organization is using, then we can call that accounting is called as the financial accounting. Then if that rupee comes in and rupee goes out for a particular production or particular product, or only if they have not taken into the consideration, then it is called as a project accounting. If that accountancy is only related to this managerial aspects, that is cash, the liabilities and the shareholders information only they are taking into the considerations, then it is called as the managerial accounting. If it is related to the government, then it is called as government accounting. If it is related to this forensic, then it is called as forensic. Tax related, tax costing means only related to this production elements only if they consider, then it is called as a cost accounting. Then if we have seen the advantages of this accountancy, it is its advantage is maintaining of the proper books of the records, that it is like a replacement of the human's memory, and it always prepares for the comparison of the results with the other organizations, and it gives them more flexibility to take the better decisions by the users of the organization. For the it helps for the taxation matters, valuation of the business, and it helps for the employees to evaluate their growth in the particular organization. It helps for the customers to have a loyal to purchase a better, prolonged or sustainable products. For all these things, they require this accounting information, and its limitations are all records only the monetary items. It won't records this qualitative items into the consideration. That too, it is based on the time value of the money. Means only it is records the real time of this land value amount which they have spent, but they won't records the market value of that lands or the buildings, etc. And the recommendations are all alternative methods. They will use many methods like depreciation calculations and all. And it is a restraint of accounting principles. Accounting principles are all there. That principles are all, each and everyone have a different difficulty in implementing that accounting principles. And the allocation of the problems, maintaining secrecy is not there. Everyone knows about their financial information. And importance for the over substances, overburdens. These are all will be done in this accounting procedures. Anyhow, this accountancy is maintaining with an objectivity to identify and the recording of the financial transaction and to ascertain the results of the financial organizations, how much of liabilities are all there and how much of assets are all there and are all. And it is there to ascertainment of financial affairs, keeping accounts of the cash, control over the assets and the liabilities, and to help for the tax filings and all is the objectives of the accountancy. So that's why the accounting functions are all recording the journal entries, classifying the records, summarizing, interpreting, analyzing, and communicating the financial information. Then, this financial accountancy's sustainability is mainly depends on these accounting principles. These accounting principles are all categorized as accounting concepts, accounting conventions, accounting constraints. These accounting assumptions, concepts, accounting constraints are all approved by the GAAP, generally accepted accounting principles. Every accountant has to maintain or has to follow all these principles. First of all, accounting assumptions means it can be defined as a set of rules that ensures the business operations of an organization and are conducted efficiently and as per the standards defined by the Financial Accounting Standards Board. Here, the first assumption is money unit. All the accountants has to measure only the items which can be measured in terms of the money only. The qualitative elements they should not take into the consideration. And every organization is an economic entity. Here, owner is separate entity concept. We can call that it as separate entity concept also. Owner is separate, even the organization is separate. So the owner uses for his personal use. We have to enter that particular transactions under personal drawings. We should not enter it as the organizational expenditure. That is the mandatory. And going concern concept. Going concern concept means they have to think if the organization is started right from the incorporations to the ending, every time they have to think that organization is going to be running for a long run. They are not going to be stopping anywhere. Till their last day, wind up day, they have to be prepare this accountancy. And that accountancy should have the breakups like for every day journal entries, every fortnight ledger entries, every month trial balances, every quarterly they need to prepare the trading and profit and loss accounts, every annually they have to prepare the balance sheets. Everything they have to be done in a periodical way. And that time period is called as the financial year or an accounting year. This accounting year consideration for the India is from April 1st to the March 31st. Whereas some of the foreign countries are all following this accounting period as from calendar year January 1st to the December 31st. And accounting concepts refers to these basic assumptions that the rules and the principles which works as a basic recording of the business transactions and preparing accounts. These concepts assumes that the purpose of or the business entities or owners are two separate entities. And the revenue recognition. Once that revenue is realized, then only they have to be taken into consideration. They should not enter any assumptions. Okay, future lo vastundi money, now I could not, they should not realize, they should not imagine, and they should not write. Once that money has received by them, then only they have to be taken to the consideration. And matching principles, they everything they should be goes out means something should be comes in, and they should be equivalent for that one. If a machinery is comes into the organization, then equivalent worth of money has to be reduced, and they have to disclose the entire information of the financial organization, and it should be matched with the historical cost of the organization. And the account, it should be a materiality. That means any materials which size makes likely to influence the decision of the organization. And if that amount is recording anticipated loss and anticipated profits, they should not take into the consideration. But anticipated losses are only they can take this any reserves, but anticipated profits they should not take into the consideration. And they, whatever the methodologies they are following, that methodology should be there at least for 2 to 3 years, or they should not, if they have to change, there should be approval from this general meetings and all. And cost constraint means everything should be in the form of the expenditures, and the objectivity of the objectivity there for the accounting objectivity has to be made by their spendings. And the double entry mechanism means once the accounting procedures they are all maintaining, that they generally single entry means let us say an income of 10,000 is received, then it is a credit plus symbol. And if they have purchased the material, if they have purchased the materials worth of 2,000, the remaining balance is 8,000. Like this, if they are doing in a single entry, then it is a old methodology. But if it is a double entry means all the incomes are all plus are under one side, and the minuses are all under one side, all the debits are all one side, and the credits are all on another side, then that is called as the double entry mechanism. So that's why double entry mechanism is a method of arranging the accounts in such a way that the dual aspects would be expressed by a debit amount, and an equal of offset credit amount will be taken into the consideration. It is a system in which every accountant can enter the each transaction into both sides of that every element. And the advantages of this double entry system is it is very easy to calculate, easy to identify this expenditures and the incomes. Double entry bookkeeping will be follow this thumb rule, that is left hand side the debit, right hand side is the credit. If we see these differences between the single entry and the double entry, it is a complete system of the accounting, and it refers to the both aspects of the debit and the credit, and it is very easy to recognize, and a trial balance is accurate positions can be evaluated in the double entry system, and it is generally accepted and using presently. And the single entry system is weed out, it is not generally used, and since there is an inaccurate trial balances were came, and it is an incomplete system of accountancy. The next thing is accounting process will be starts with journal entries, and this is a journal format, that is date format. This is called as the title, particulars format. This is a ledger, general ledger reference column, debit and credit column. So if we have to prepare this journal entries, we have to understand these three rules, that is types of the accounts. The accounts types are all real account, personal account and nominal account. All the assets comes under the real accounts, tangible and intangible, and all the persons Like the debtor and the creditors will be comes under the personal account. Income and expenditures will be comes under the all the other remaining elements will be comes under the nominal account. The rules for the real accounts are all debit what comes into the organization, credit what goes out from the organization. Personal account means debit the receiver and credit the giver. Nominal accounts means debit all expenses and the losses, credit all incomes and gains. Personal account. So natural persons accounts like Rama, Rita, Ravi, etc. will be comes under the personal account, whereas an artificial persons accounts are also will be comes under the persons account like business entities, Microsoft Company Limited, Wipro Company Limited, Government Company Limited, clubs, cooperative societies, etc. There will also be comes under the personal accounts. Persons representatives. If any owner is withdrawn for his personal use, that's drawing account will also comes under the personal account. Outstanding liability or the prepaid accounts, capital is also investing by a person or the owner. On behalf of them, the capital is going to be investing. So we can treat that capital is also comes under the personal account. All the other tangible and intangible items like cash, buildings, purchases, sales, etc. will be comes under the real account. Other including other all the other items like rent, lighting, insurance, salaries, wages, dividends, etc. will be comes under the nominal account. The next procedure is once the journal is prepared, the next item is to prepare the ledger. Ledger is in accountancy is the second book of the entry. Whereas in the journal only whatever is the transactions are all there, debits of one particular account and the same particular account's credits are all going to be verifying. Then it is called as the ledger. That this is the ledger pro forma. And some of the examples is only for the bank accounts or only if they have prepared, then it is called as the ledger. The advantages of the ledger is to complete information at a glance, arithmetical accuracy, results of the business operations and accounting information. And the limitations of the ledger are these are all not entered at all in the journal if they are not recognizing. If at all any wrong entry has done in this journal, that is not again analyzing here in the ledger. Next concept is the trial balance, and finally how much of amount is received and how much of amount spending by the organization can easily identify in the form of the trial balances. And trial balances after they will prepare this trading account, that is the direct expenses done by the organization, and they after the trading account they prepare the profit and loss account, and in this profit and loss account they'll going to be analyzing what are the indirect expenditures done by the organization or the entire operational profits of the organization. And finally they'll prepare the balance sheet. In this balance sheet they'll see whether the accounting equation is going to be satisfying or not, and based on that one only they'll take into the consideration. And is there any misusages are not going to be analyzing here. And with the help of the ratios, once this balance sheet is prepared, they are going to be helping or they are going to be analyzing the balance sheet information, which is made easy for the users. For this one, they are using these ratios like activity ratio, solvency ratio, liquidity ratio, market value ratio, and the profitability ratios. And these ratios are all very important for the organizations to identify easily the financial information of the organization. These ratios include the liquidity ratios that may be furtherly divided as current ratio, quick ratio, cash ratio, and defensive interval ratio. And the liquidity ratio activity ratios will be included: accounting receivables turnover ratio, inventory turnover, accounting payables turnover, working capital turnover, fixed assets turnover, and total assets turnover. In and all, with the total activities, how much of returns they are gained is going to be calculating with the help of the assets turnover ratio. And the next thing is capital structure ratio, that is debt equality ratio, proprietary ratios, interest coverage ratios is going to be calculating with the help of this capital structure ratio or the solvency ratio, and they will take this profitability ratios, means gross profit ratio, net profit ratio, earning per share, return on investments, earnings before interest and tax, and overall profitability position of the organization can be calculated with the help of these profitability ratios. And finally, the concept is about the DuPont chart. DuPont chart is an analysis that identifies a framework for the fundamental performance of the organization. This is very useful to decompose the different drivers of returns on the equity. These key factors are mainly based on the net profit margin and average turnover and economical margin, which is going to be gaining by the organization. These are all mainly focuses on the operational profits margin, assets turnover, overall how much of returns are gained by the organization. So this can be more helpful for the users whether the organization can do furtherly or not. That is about the accounting information of the organization at a glance. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.